Welcome to ODEON Capital Conversations on all things money and markets with Dick Bove and Matt Van ALSTYNE. And here is your host, John AIDAN BYRNE.
As mortgage interest rates in the US hit their highest level in over 20 years, Dick Bove sees a breakdown in the homeowner financing system and a very real possibility of a coming housing crash as demand for homes outpaces supply. Matt Van ALSTYNE says it could all fall back on the Fed in the event of a housing crisis, along with a fresh round of QE and more Fed intervention. We look at that on this episode of ODEON Capital Conversations, as well as at the new bank capital rules for banks as S&P downgrades 5 regional banks. Dick Bove examines and praises the record of Goldman Sachs CEO David Solomon. Some positive news on investment banking and deal making will be discussed. China's economic troubles continue. We look at that and more. I'm with Dick Bove, Chief Financial Strategist at ODEON Capital Group, and Matt Van ALSTYNE, ODEON co-founder and managing partner. And we'll be right back after this message.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.
Dick and Matt, welcome for episode 83. We will have Jerome Powell speaking at Jackson Hole this Thursday and Friday. We'll see how that shakes out. I'm sure you're going to be paying close attention like the rest of Wall Street. According to minutes from its last meeting in July, the Fed seemed to hint at more rate hikes this year. And of course, that resulted in the bond market was rattled, pushed up long-dated bonds. But many out there are looking for a series of rate cuts, but not you, Dick, at least recently. What's your thoughts?
Well, I mean, my view is that the Federal Reserve is going to maintain its posture that it has to defeat inflation. It believes that it has not yet defeated inflation because they are apparently going to stick to this 2% level of inflation, which I think is the right thing to do. And I think that, basically that means that interest rates have reached a new level. And they're not going to come down very rapidly from that level. Whether they push it much higher or not is unclear. But, I think Wall Street is expecting in 2024 to see some significant cuts in interest rates. Some people think as many as 3 cuts. I know Matt's on a different side on this thing, but I don't see them cutting. So maybe Matt will give his theory as to why they might cut.
Well, I've been wrong about my predictions on their rises this entire time, just a caveat. But I've kind of had the view that they're trying to raise interest rates as much and as high as they can before they break something. And then once they break something, and I don't know what that thing would be, they're going to have to lower interest rates to recover the economy. It's gone on a lot longer than I expected. But the stock market is still basically going up. I think it's up 17% year to date. In an economy where the consumer polls show that only 30 to 35% of the public is optimistic about the economy and feels good about their own economic situation. And so you have a disconnect. Either the bond market is wrong and interest rates are going to be a lot higher for a lot longer. I mean, you see the 10-year above 4%. You see mortgages closing on 8%. The 2 years above 5%. You have an inverted yield curve that's been inverted going on 9 or 10 months now. And so the bond market is clearly pricing in a recession. And then you have the stock market, which sure seems to think like it's all systems go and we're going to have a soft landing. One of those is wrong.
The thing that is going to break, in my view, is housing, because the mortgage rate at the present time, or at least yesterday, it was published that the mortgage rate hit 7.5%. Now, 7.5%, happens to be, I bought my first house in 1972 and the mortgage rate was 7.5%. So it doesn't sound that alarming to me, but it is alarming to the housing market, which, was accustomed to rates somewhere between 3 and 4%, as short a period as a year ago. And I think that what we're dealing with at the moment is the fact that we've seen a breakdown in the housing finance system. Banks are sitting with, huge hundreds of billions of dollars of mortgages on their books, which are yielding 3.5%. And, that cuts into their ability to pay market rates for deposits. So they're not very, very, very happy about taking on more mortgages. Mortgage bankers are happy to write as many mortgages as they can, but they don't have any money to hold mortgages on their balance sheet. So the question becomes, who's going to pick up these mortgages? Now, historically, that has always been Fannie Mae and Freddie Mac, and now Ginnie Mae. But the point is that because these companies are in their conservatorships, they can't pick up these mortgages. So we're moving toward a crisis in housing, on the ability to provide the housing to meet the demand, and that's going to impact the economy. Now, it gets kind of interesting in my view, because 2024 is a presidential election year, and in a presidential election year, whoever happens to be in the White House at the time wants the economy to be really moving very strongly, and proposes all sorts of legislation to get the federal stimulus to keep the economy moving. But in this case, they can't do that because they can't get Congress to go along with stimulus bills in order to stimulate, the economy. So it's got to be housing. And if it's going to be housing, and housing isn't all the trouble it's in right now, I think that the Democrats are going to take these two companies, Fannie Mae and Freddie Mac, out of their conservatorships, which they don't need Congress to do. So I think housing becomes really interesting over the next 6 months. I think the Fannie Mae and Freddie Mac become really interesting. I think housing is going to be the key focus in the economy for the next few months, because housing is clearly in a lot of trouble.
Are you predicting a housing crash? Because we've talked at length about this. I think we've both agreed that there's actually a supply shortage kind of underpinning housing prices, and the supply shortage is exacerbated by people who have locked in 2.5% money for the next 10 years or 30 years. And if they sell their house now, they'd have to replace it with a house worth half the amount to keep their payments static. So they're kind of in these golden handcuff scenario, which exacerbates the supply problem.
Yeah, no, I think the possibility of a housing crash is very real. I think it's very real because the demand for housing, if let me step back. If you go back throughout this whole century to 2000, there has never been a strong demographic demand for housing. Even in the period in which housing soared between 2006 and 2008, the demographics did not argue for that increase in housing. It was all, a flow of funds coming into the sector, driving rates to a level that were attractive, and the speculative, surge in housing prices, which got that surge in housing activity. That was not need for houses. Right now, we have a real need for houses, and as you correctly state, Matt, there is no way to deliver them. There's no way to deliver them because people who live in them at the present time with mortgages, at less than half of 7.5%, are not going to sell them. And we can't deliver them because of the zoning problems, community by community across the nation, which prevents, the building of housing. I mean, I don't know if it's true, but builders argue that in California right now, it takes, literally 10 years to go from buying a piece of raw land to getting the appropriate, zoning for subdivisions. So the net effect is we have a crisis. We have a crisis even more so because money flows into the mortgage market, are not going to be there because Fannie and Freddie are not there. The banks don't want to buy the mortgages, and the mortgage bankers don't have the money to buy the mortgages. So, I think we're moving toward a significant housing crisis, could be a housing crash, and I think that the government is going to react to that, at some point in the next 4 to 6 months.
I think the thing that tips me against that view is the government is incompetent. Unfortunately, our elected officials and our bureaucrats are not up to par to fix Fannie and Freddie. When you have Barack Obama, allegedly, I'm just reading the papers just like everyone else, but he wanted to fix Fannie and Freddie for his, basically the entire 8 years of his term, and could never get to a point where they could resolve all the thorny issues. And we've talked at length about the thorny issues. I know you've written a lot of reports. You can go back and find them on our website on the thorny issues that involve Fannie and Freddie. Then you have these lawsuits that go to the Supreme Court, which, a layman's reading of the laws are that these cases should have legs, and the Supreme Court goes out of their way to make sure that they don't, step on the toes of the executive branch. And then Donald Trump came in, and Steve Mnuchin was very clear, and he came from Wall Street. He has lots of friends that were, I'm assuming, were invested in Fannie and Freddie, and he spent 4 years and couldn't get to a point where he could even get a basic plan. So the idea that somehow out of nowhere, if there's a housing crisis, that the government's going to get their act together and fix Fannie and Freddie just belies everything. And then I look at like the most recent crises that we've had, in the financial sector, where I'm thinking of Silicon Valley Bank, which is basically the FDIC bureaucrats who didn't do anything to be prepared for that type of liquidity crisis, or when they do the stress tests, they didn't test rising interest rates as a problem. And it took the Fed, again, the only entity that's somewhat powerful, and I know we talk a lot about the Fed and their problems, but they're the only entity that I can see in the federal government that has the power to do anything. And at the end of the day, your thesis, in my mind, is based on bureaucrats who have no track record of being competent suddenly finding competency and performing well. And I think what's actually going to happen is when it all hits, it's going to be on the Fed, and they're going to have to do QE, and they're going to have to buy mortgages, and they're going to have to lower interest rates, and that's how they're going to save the housing market.
Yeah, well, I'm not going to disagree with you. I believe that the incompetence demonstrated by the bureaucracy is legendary, and I think the incompetence in the bank regulatory area, is a pretty good example of that, inability to function properly. But if the crisis in housing, gets to be what I think it's going to be, people wanting more houses, people having families, people getting, young people getting married, having families, because that's the age group that provides the demographic pressure on housing. And that's the age group which is growing right now. They can't deliver, the housing industry can't deliver what they need, then, someone's going to come up and say, wait, hey, we don't need Congress. We don't need anybody else's authority. The Housing and Economic Recovery Act of 2008 gives us the power to simply release these things from their conservatorships, and done. We're going to do it. Because, if the Fed,
I'd like you to be right.
Yeah, I would too. I own the stocks. But the point is, I don't know. My belief is that there is a fund flow crisis in housing right now, and there is a solution to it. And I don't think, Joe Biden is going to say, "Hey, I don't give a damn what happens to housing. I don't give a damn what happens to the economy. I'm going to be elected." I think he's going to say the opposite. He's going to say, "What the hell's going on with housing? What the hell is it doing to the economy? I'm not going to get reelected if you guys don't solve this problem. Go solve it."
Easiest solution is for the Fed to print money and lower rates.
Yeah, that's the easy solution, but it's going to send inflation spiraling.
So we could potentially, Dick and Matt, be looking at a housing crisis. I mean, isn't some of the demand for housing now post-COVID psychology as well, that nobody was buying then, and it varies by regions, right? I mean, so in the Northeast, prices still climb, and then in other markets, they're down by 10%, as much as 10%. So mortgage rates running at 7%. Here's an interesting personal finance calculator on a $500,000 home. If a buyer puts down 20% down payment, that's $100,000 at 4%, at a 4% mortgage rate, that would come to, according to the calculator, $290,000 in interest payments over a 30-year life of that loan. So borrowing $400,000 now on a 7% mortgage rate, which you were talking about there earlier, Dick. That's what you paid for your house. You had a 7% interest rate. The borrowing, 7.5, slightly more. Okay. So the borrower on a 30-year loan would pay about 560,000. So that's a lot of payments. And I have a daughter and her husband looking for a house in the Northeast, and it's really, really difficult. You go look at, let's say, making up a number here, $500,000 home. There'll be 17, 20 buyers lined up, and they will pay 15, 20% over the list. I mean, it's just extraordinary, at least in this market. And just another little anecdotal information. Some people I know in the hardware industry here in the Northeast were saying the demand for moving boxes has gone up tenfold in the past few months. I mean, houses are selling fast here if you can buy one.
Yeah, well, they're not selling fast in terms of the statistics that come out of the National Association of Realtors. But I think it's more relevant to think about your daughter's situation, because I like to use personal anecdotes as opposed to big statistical numbers. But the fact of the matter is that the ability to afford housing is dropped dramatically, because people buy houses based upon what the monthly payment is. You know, the price of the house is somewhat irrelevant. It's what do you got to pay for that? What do you got to pay for this thing on a monthly basis? And can I afford that? And essentially, when you get to 7.5%, you knock out all those people who could afford houses at 3% and 4%. And, you know, as I say, the supply of housing isn't there. The demand for housing is huge. The money flows to accommodate that demand are not there. And that's the basis of a crisis. And I feel very, very strongly that we will be in a crisis in the housing sector, if we're not already there, in the next, 4 to 6 months.
Would one more interest rate hike tip us into that crisis? Because mortgage rates potentially would move up as well.
Yeah, no, I think we're there. I think 7.5% mortgage rate is there. You know, people can't believe, down here in Florida, my grandson is getting married, and he set aside the money to buy a house. And all of a sudden, he's finding that, my goodness, 7.5%, that changes the whole calculus as to whether I can afford this thing or not. And, we're talking about millions and millions of people who are in the same situation as your daughter and my grandson. They simply can't get what they want because it's not there at a reasonable price. And it can be there if we change the structure of Fannie and Freddie. It can be there if zoning regulations adjust. At least in Texas and Florida, zoning is not as difficult as it is elsewhere in the nation. So you're getting housing production in those two states. But the fact of the matter is, we need housing. House the people who want it on a demographic basis. We need housing to maintain the growth in the U.S. economy. We're not getting it. Something's going to be done about it. That's my theory.
I do want to point out, and when we talk about housing, it's a lot more expensive and a lot more immediate impact on people that are renters when prices are rising, because they renew their cost of living every year. And the vast majority, I mean, I believe there's something like 145 million homes in the United States of America. And I just looked it up, since the mortgage rate spike of about roughly a year and a half ago, there's been almost 2 million homes sold. So, just back of the envelope, roughly 98%, 99% of the people that are homeowners have not experienced the price spikes that Dick is talking about. Because unless you bought a home in the last, unless you're one of those people that bought one of the homes during the rising mortgage rates, you have a dramatically lower cost of housing. And the odds are, based on, the changes that came through in 2008, you're probably in a fixed rate mortgage. And so this is not impacting you. This is impacting exactly who you guys are talking about. John's daughter, Dick's son or grandson, I can't remember which one it was. And, you're going out there and you're having sticker shock because, when you got married 3 years ago and you had a 3-year plan to buy a house, and you're saying, okay, I want to buy a $500,000 house. We have to save $100,000. When we get to that point, it'll cost us $2,000 a month. And all of a sudden you got to that point and now it's going to cost you $4,500 a month. And the math stops working. You can't afford to buy a house. And so now you're going to be stuck renting. And you're going to be stuck renting until something changes. But if that thing that changes is the house prices drop dramatically, we're going to be in a totally different economy. You might not be able to afford that house for different reasons, because maybe your job is more at risk, or the economy is crashing and it's hard to catch a falling knife. I just feel like this is much more overplayed than it actually is, because the 60 to 70% of Americans are homeowners. Of them, only a small fraction has these high jumbo interest rates on their mortgages. And the people who are renters, well, the renting price increases were way more dramatic in 2020 and 2021 than they are now. And that's one of the reasons we've had lagging inflation, is because the housing prices are slowly hitting the official numbers. But I remember 2021 when you had year-on-year average rental increases of 20%, and that was really impactful to those people. But it's not to the majority of residents of the United States.
Yeah, but what affects GDP is the new housing construction, and new housing construction is not going to be there. And the people who are renting are going to be screaming. So we'll see how it plays out, but I think the pressure is there, and it's going to be ugly over the next 6 months.
Dick, there's continued focus and attention on the new bank capital rules. There's a hue and cry about it. The banking industry seems to be pushing back. That's not surprising. Where are we at right now? Is it going to damage the banking industry? That seems to be the bigger question, because if you listen to these bank executives, they're going to say, yeah, it's going to hurt us, and it's going to hurt the wider U.S. economy because it's going to crimp lending.
Yeah, I based upon some feedback I got, I didn't do such a good job in explaining how negative this situation really is. But this morning, Standard & Poor's followed Moody's and Fitch's and downgraded a whole bunch of banks. And they downgraded the banks because of two very simple reasons. One, when interest rates go up, the value of bank assets go down. So when the value of bank assets go down and the yield on those assets is very low, it prevents the banks from paying up to get new deposits. So deposits go down. So the banks are now faced with a situation where there's been about a 25% drop in the non-interest bearing deposits in the banking industry. And the banks can't simply go around and say, okay, we'll get that money back because we're going to raise interest rates. They can't, because they can't raise interest rates if they're not getting the yield off their assets to allow them to pay the higher interest rates. So the government now takes a look at the situation, and it's saying, hey, you're saying that these assets are worth $100, they're worth $80. And you're saying that the equity in your institution is $10, it's $7. And we don't want the equity in your institution to only be $7. We want it to be $10. So if we're going to tell you, if you continue to maintain this balance sheet at the same level or grow it, we're going to make you bring that $7 up to $10. You're going to have to add more equity to your balance sheet if you want to grow your business. And the banks can't do it. So the banks, therefore, have got to shrink. How do they shrink? They stop making loans. They stop buying securities. They stop bidding, high rates for deposits. And then what then happens to the economy? If the banks don't want to make loans because they can't pay the market rate for deposits, if they don't want to make loans because they don't want to come up with more interest on the, not interest. They don't want to come up with more equity to put on their balance sheet because that means selling stock, then the economy is going to be affected, because there's $23 trillion in assets in the American banking system. You don't have that pool of money sitting out there to replace the money that the banks would make available in loans if the banks stop making loans. So I think that's the risk that the economy faces, but it's a lot worse than that, because if the banks stop making loans, and they won't stop completely, obviously, then the loans will be made by non-banks, right? The non-banks have to pay a lot more for money than the banks do. There's no FDIC insurance for the non-banks. So that means that the loans made by the non-banks are going to have much higher interest rates. Number one. Number two, nobody is auditing the non-banks. Nobody audits, Rocket Mortgage, for example. There's no system set up to do that. So the net effect is they're going to make a lot of bad loans. All right. So what we do when we force this problem on the banking sector is we're creating high cost of money for borrowers, and we're creating a potential financial crisis with bad loans that will be made by the non-banks. And this is very concerning. And I think it's another problem. It's the reason, why the bond market is arguing, one of the reasons that the bond market is arguing so strongly for a recession, which is what Matt said a little bit earlier. So the net effect is, I think that this banking situation is a crisis. The crisis started, when the Fed started raising rates without thinking about the impact on asset values. And it was increased by the fact that once they increased interest rates, the regulators who were supposed to tell the banks how to protect themselves and force them to do so ignored the whole situation and did nothing. But now, it's here. It's here. What are the banks going to do? Are they going to continue to see other people say, hey, you can't borrow money at the rate that you think you can borrow money at because everybody's downgrading your business? So it's another. Housing I see as being a problem. This I see as being a problem. And therefore, it makes a situation really uneasy, because on the other side, you got all these people with jobs, making more money, getting more profits from the stock market, the houses that they own. You got that on one side, the stock market's reacting to that. On the other side, you've got the problems generated by, potential increases in interest rates, which shuts down money flows in the economy. And those two forces are going to crash here and clash here. And we're going to see which side is more powerful.
Is it crazy of me to sit here and think of all the things you're describing? I'm like, wow, lower interest rates sure would help the banking system. And yet you seem to be against my view that lower interest rates are coming.
No, lower interest rates are exactly what the banking system needs. The question is, what will create the lower interest rates? And I believe printing money will not create lower interest rates. I think it'll create higher levels of inflation and higher interest rates.
If they went down a path of yield curve control and expanded QE as a way to lower long-term end, and then they cut rates at the front end, kind of like the Japanese have been doing for the last 20 to 30 years, isn't that a way to reinflate profits at the banking system and stimulate lending?
You're absolutely correct that's what the banking system needs. And that's what everybody wants. And the stock market believes with certainty is going to happen in 2024. Again, this presidential election year, which screws up everything, economically and financially. And we'll see. I mean, as I say, maybe they can get away with printing more money to lower and setting rates. And maybe the bond market will say, no, we're not going to listen to you. If you're going to print money, we want more and higher, returns on our investments, and therefore bond rates are going to continue to go up. I don't know. What I've been doing for the last few podcasts is hedging my bet, because, essentially, I don't think, and I think the Fed is demonstrating the same lack of conviction. I don't think you can call it yet. I don't think you can call which way it's going to go.
I understand, Dick, the core argument for more capital at the banks, but I'm reminded of what Matt has repeatedly said. In a sense, banking is kind of one big confidence game. I mean, if consumers and savers and borrowers get nervous and skittish about the banking industry, there'll be a run on every bank, and then the government will step in and bail them out anyway. So, I mean, I just wondered, are we overemphasizing these capital buffers?
Well, number one, it's not a confidence game. The banking system in the United States has functioned to allow people to borrow money for hundreds of years. And as a result of the banking system operating in a very efficient and fashion over this period of time, people feel safe with their money in a bank. They're not pulling their money out of the bank because they're worried about the safety of those funds. They're pulling the money out of the bank because the bank is giving them 1.5%. They can get 5% somewhere else. Actually, the banks right now are paying 1.41% for deposits on average throughout the whole industry. So it's not that they don't have confidence in the bank. It's that they want a higher return on their money. Money in the bank is safe. It is safe. We are not sitting in a situation where we were in 1932, where the banking system would collapse and you just couldn't get your money out, period. That hasn't happened for 100 years, almost 100 years in this country. It is not a confidence game. All right. Secondly, people borrow trillions of dollars from the banks. I think bank loans now are somewhere around 15 to 16 trillion dollars. They're not being harmed by the fact that the banks are lending them that money. I think that the banking system is a lot sounder than you might think it is. Basically, they didn't raise interest rates. The Fed raised interest rates. They didn't, see the value of their assets go down because of anything that they did. The value of their assets went down because of what the Fed did. They have no control over interest rates. And the bigger question, I guess, which we just talking about a second ago, Matt thinks that there's availability to control those rates and to increase the money supply. I question that, thinking that maybe there isn't that availability to increase money supply, and that the bond markets would react very negatively if the Fed started to print money. But again, we'll see.
But at its core,
I want to defend myself a little bit. I don't think I ever called the banking system a confidence game. To me, that makes it sound like it's a scam. That makes it sound like it's you call con men play con games. And I don't think the banking system is like that at all. What I think I said was the banking system is uniquely right when the broad customer base believes in it or when they don't believe in it. Silicon Valley Bank was fine until they lost the confidence of their customers. And the reason they lost the confidence of their customers was, well, a couple of strategic mistakes. Some of them were long-term, but really the big short-term one was when they sold their long-dated portfolio at a discount to where it was on the balance sheet. And, the customers who were paying attention kind of felt like the emperor had no clothes. And if they applied that same math to the rest of the balance sheet, they realized, oh my goodness, the rules of the game are I get FDIC insurance up to 250 grand. Everything else is at risk. If I want to be safe and I'm looking at this bank and I'm doing the math in my head, and it's everything Dick's been talking about with all these other banks and with the Fed, which is if you mark to market, they're deep underwater. And people did the math and they realized, hey, I'd rather not have my money in a bank where if they fail, I'm not going to get the FDIC insurance. And so the confidence was lost. But I don't believe it's a confidence game. And I agree with Dick that the banking system is extremely sound and the FDIC has more than enough resources to shore it up. And I think the Fed does too. I think the American banking system is the safest place in the world. I think that's one of the reasons, we have the advantages we have is because foreign entities and foreign people like to use America's banking system because they have more confidence in it than other banking systems throughout the world.
Yeah, but in that sense, you've used the word twice or three times. Confidence is important. It underpins
100% confidence is. I think the phrase game, throwing the word game behind it makes it sound.
Well, let's remove the game, but certainly, I guess what I was driving at also is that, and correct me if I'm wrong here, Dick, isn't it a fractional system for all intents and purposes? I mean,
not anymore.
No,
we do not have. When they set up the banking system, and when you read the school books, it says that the banks have to put a certain fraction of their deposits at the Federal Reserve in order to back up, the banking system. Well, the Federal Reserve has taken away all of those fractions. It's not, there is no more fractional banking system in the United States. The banks do not have to put, any meaningful portion. Maybe it's around 0.1% or 0.001%, but no, we do not have a fractional banking system.
So is that why now this renewed emphasis on capital is playing a vital role?
Yeah. In other words, what the regulators are looking at is two things. Number one, most important is liquidity. In other words, they want a bank to have enough in pure cash on hand and enough in treasury securities or federal fund securities, that they basically will have the money if there's a run on the bank. In other words, the way to stop a run on the bank is to prove that to everyone that there's money in the bank to take care of your needs. And, that requires liquidity. And now the banking system has to have roughly 22 cents of every dollar in assets have to be liquid enough that the banks can pay it off immediately if there's a run on the bank. In Silicon Valley Bank, that was not the case. All right. That's what that's what the regulators want. And how do they get that? How do they get that liquidity in the bank? They force the banks to increase their equity, but the equity can't be used to buy loans. The equity's got to be used to buy treasury securities or to be deposited at the Federal Reserve. And therefore the liquidity will be there. And the money, is in the banking system to protect the banking system. The banking system, in general, can protect itself. And it's shown that in the last, 5 months now since, because, there were a couple of runs on a couple of banks, but that was it. And nobody lost any money as a result of it. The liquidity is there.
Very secure in the sense that the regulator stepped in, and we have FDIC insurance and sort of blanket guarantees, and all of that certainly bolsters the American public's confidence. According to writers, one proposal in the latest plans would require banks in aggregate to set aside an extra 16% in capital. Does that number sound right, Dick?
It sounds reasonable. I have never calculated what I think they need. Because my calculations is how much are they going to shrink to reduce their need. But I would assume that Reuters knows what it's talking about.
Goldman Sachs is in the news, has been for months. It had a lot of layoffs this year, and the CEO, David Solomon, has been taking some criticism, perhaps for his brusque management style, and for other reasons. And of course, it has had trouble with its Marcus unit, and it's looking at some reforms in its wealth management side. Is it in a good place?
Yeah, I think Goldman Sachs is one of the best companies in the United States. But the issue that you raise is the personality of the CEO. And it's to me, that's where the fascination lies. In other words, the guy is a tough guy, very brusque manner, take it or leave it, to the people who work for him. And essentially he's created this firestorm where these people have been talking to the press. So the New York Times, Bloomberg, just about the London Times. These are all people I've talked to. They all want his head in a noose, right? But you have to say, what did this guy do that was different than what all these other guys did who run banks and who got praise for doing what David Solomon is doing right now? And I'd like to give you some examples. When Jamie Dimon, who probably is the best manager of banking ever, essentially took over J.P. Morgan Chase, he fired all of the Chase people. He left, of course, one or two there, but he brought in all his people from Bank One, and he did exactly what Solomon did. He got rid of the people he didn't want, and he did it fast. When Brian Moynihan took over Bank of America, he essentially started by firing tens of thousands of people. And he ultimately wound up reducing employment by 84,000 people. He got rid of 84,000 jobs. He was widely praised for doing that. Nobody's gotten rid of 84,000 jobs that I'm aware of anywhere. And yet they didn't criticize Brian Moynihan for shaking up everything. They praised him for doing it because he lowered the cost of running the company. When Charlie Scharf took over Wells Fargo, every person in the upper layer of management in that company was fired. Everyone. Not one of them is there today. He got rid of every one of them. So, again, people praised him for doing that because they thought it was necessary to be done. If you go down to Citigroup, Jane Fraser, she was in the press, yesterday because of another shakeup that she's doing, which is going to change people's position and people are going to lose their jobs. And of course, James Gorman, who is, one of the great heroes of Wall Street at the present time, when he took over Morgan Stanley, it was in the midst of this massive fight between Phil Purcell and John Mack, as to who was going to run the company, and whoever was going to win that fight was going to fire everybody else's, subordinates, right? But they gave it to the right guy, James Gorman, who is absolutely brilliant, and they basically let him do what he wanted. What did he do? He created this study of management, and he started removing people out of every department. So the question in my mind is, okay, all these guys fired everyone who wasn't on their team. Every one of them did it, right? David saw it, and they got praised for doing it. They got praised for doing it. Gorman was praised for his management style. Jamie Dimon, was looked on as a semi-god, which I think he might be. And then, there's Brian Moynihan, 84,000 jobs, and he gets praised for doing it, not criticized. Goldman Sachs, David Solomon does it, and they want to kill him. They absolutely want to kill him. All these people were making multi-millions of dollars a year, because if you're working for Goldman Sachs and you're in the upper echelon, you're making millions of dollars a year. These guys are running to the press saying, this guy, Solomon, is a bad guy. He's doing all this bad stuff. He isn't a bad guy. He's doing what everybody else did. So the message that I think should get to CEOs is your personality counts. The way you do things counts. You can do things similar to everybody else, and you can get pilloried for it for being the wrong type of person, or you can get praised for it for being the right type of person. And unfortunately, David Solomon wound up as the wrong type of person. He did a number of things at Goldman Sachs which were very, very beneficial for that company. And, we wrote a report, and again, we do not have any connections, et cetera, et cetera. But, we wrote a report, about 4 days ago saying that it would be definitely incorrect to fire this guy. This guy is on the right path. Goldman Sachs is an extremely strong and profitable company, and it will be a major, major beneficiary of investment banking going forward. And therefore, buy Goldman Sachs. Don't jump on it.
It's also selling its fintech unit, I should say, too. Green Sky.
Listening to what Dick's saying, and just what comes to mind is Machiavelli, who says that leaders, should choose early if they want to be feared or loved. And, he kind of says that fear is better. But if you don't have either fear or love, then you're the most vulnerable leader that is out there. And I think that's what David Solomon isn't having, because you wouldn't have these leaks if he was feared, and you wouldn't have these leaks if he was loved. He's probably in a bad situation because of his personality, because of what Dick's saying. He's a competent, capable CEO who's doing what probably the right things for the company. And yet, you get these leaks in the media, and they're not coming because he's feared, and they're not coming because he's loved. They're fearing because he's neither.
Well, I mean, he's a colorful personality. He's a DJ. That didn't sit well, apparently, with some of the executives. He's single, and he's this brusque personality, but maybe is the evidence of his success or otherwise in the share price, which is still up since he took over in 2018, just down a little bit this year by 5%. So he might be, as you say, Dick, doing something extremely well.
Well, what he did, which was extremely well, is very clear. It's not hard to figure out. For 10 years prior to his taking over, the company was headed by a guy named Lloyd Blankfein, who was loved. All right. Everybody loves Lloyd Blankfein except me. All right. And the reason why I don't love him is because at the end of his 10-year period at the head of the company was earning the same amount as they were at the time he took over. And at no time in his whole 10-year tenure did the revenues of his company go up above where it was when he started. And the reason for that was because, the nature of the business had changed, and Goldman Sachs had not changed with it. Goldman Sachs was still building their business every day and they would not, in control of a huge amount of recurring revenue. Recurring revenue comes if you've got an asset management account, which is paying you on an annual basis. Recurring revenue comes if you've made a loan 5 years and every month you get a payment on that loan. Recurring revenue comes if you've built in a lot of deposits, because those deposits are pretty much going to stay there, despite what I said before. And therefore, what Goldman Sachs needed to do badly was to build businesses which gave them recurring revenue. He did that. He moved too fast into too many businesses. He didn't realize the amount of losses that he was going to have to take to build those businesses, and that was his mistake. But the fact that he moved into recurring revenue businesses changed the nature of Goldman Sachs the way it needed to be changed. So he did the right things. But believe me, I'm not sure I'd want to work for him, given how tough and mean he is. But the fact of the matter is, stockholders should want to have him as their leader, because he's getting them results. As we talked about last week, the average bank in the United States has a stock price which is below where it was 5 years ago. Goldman Sachs' stock price is up 30%. It's got to be a reason for the difference.
Yeah.
Right. And the fact is, David Solomon is one of those reasons.
It should be noted, and there's obviously been a cultural change there when it moved from being a partnership to a public company. Clearly, that changes a lot of how things are done. So some of the old guard are still there. So maybe there's a whole transformational crisis of sorts.
Goldman Sachs people are extraordinarily bright, extraordinarily capable, and paid staggering amounts of money. They could make as much as the second baseman for the New York Yankees to show you how much money they could make. But the point is, they talk to the press.
Yankees would want to play a bit better, though, Dick.
Well, I'm not sure there is a New York Yankees this year. But the point is that these guys talk to the press, and the press loves to hear bad stories about management. And so they're running to the press, crybabying all the time. What was it? A couple of years ago, they were crybabying because they had to work so hard, to make their multi-millions of dollars a year. They felt they should have to work less and still get the multi-millions of dollars a year. So, and the press loves to build up these stories. But, you gotta put the press aside, because they're getting fed information from crybabies who are making millions of dollars a year. And you got to take a look at, what is the company doing? Do they have the right strategy? Are they being managed in a fashion to move that strategy along? And in Goldman Sachs' case, they definitely do.
Okay, so we've had all these interest rate rises, and we're waiting for the outcome of Jackson Hole. We talked about housing, investment banking, Dick. Some new numbers out there.
Well, investment banking is in a depression in the last 12 months, right? Because, of the change in the interest rate environment, the change in money supply, the change, the size of the money supply, the changes in the structure of the economy itself, and therefore, it is gone through, cutbacks, dramatic changes in China, even, where they're all getting kicked out. But the point is that that has resulted in a lot of layoffs. It's resulted in lower income in the industry. But in June, as a result of the dramatic increase in the stock market, and until just a couple of weeks ago, the improvement in the bond market, the game changed. Companies started borrowing money again. At all levels of the industry, from investment grade bonds, down through high yield bonds. Companies started bringing stock to market again, and the investment banking and mergers and acquisitions started to pick up again. So all of a sudden, this industry, which was in this, I'm going to say, depression, is seeing the sunlight. There's going to be this offering of a company called ARM, ARM, which is going to be done, I don't know if it's today or tomorrow, which is going to bring, literally billions of dollars to ARM. And hundreds of millions of dollars to investment bankers. So I think that industry, and we're going to have far more specific figures for you next week on this, but I think that industry has turned a corner. I think that the bad time is now over, and I think that there's real opportunities in that sector, both for investment and because of what it's going to do to assist the financial industry.
That's really one good positive, because meanwhile over in China, there's a lot of fear. And I'm wondering, should we be really fearful, or will this all be contained? Looking at the headline in the journal, China's 40-year boom is over, raising fears of extended slump. Could there be some kind of contagion of the don't pull out of this slump we're seeing in China?
This guy Xi Jinping is really interesting, and he is really fascinating to watch, because there are no more communists in the world, right? Except Xi Jinping. He is making sure that the companies in China do not get overwhelming power, and he is trying very hard, at least in terms of all the speeches he makes and the stuff that he writes, and actually the actions he's taken against corporations to distribute wealth more evenly within the country. I mean, I don't like him because, of what he's doing, in his foreign policy, but he is attempting to reconfigure the Chinese economy. The problem with his concept is that it doesn't work. Capitalism works, communism doesn't work, and I think that, under Deng Xiaoping, however you say that guy's name, China made the decision to go for capitalism and not communism, and they had 30 years of magnificent growth. Now, Xi Jinping, as I say, intellectually fascinating, is trying to move him back. He's trying to move back all of the, if you will, changes that were made under the prior, if you will, 30 years of capitalism in China, and it's hurting China. It's hurting China very badly, and it'll be interesting to see if he can pull it off, or whether there's going to be riots all over the country, because if you're a person under 25 in that country, you can't find a job, you can't find a wife, you have to live with your parents, they're sick of you being there, and you're going to riot. So we'll see what happens there, but intellectually this guy is really, really interesting.
China's in a pickle, and it's a big pickle, and it's something we've talked about a lot. The demographic issue, but also as they chose, when Dick says he's the last communist, I'm like, well, you should swim a little bit south of you down to Cuba, because they actually don't actually mix communism with capitalism, because what China chose was this bifurcated route where there's going to be a somewhat dictatorship-like government controlling a capitalist, or at least to take the handcuffs off of socialism and communism and let companies try and prosper. And the real problem they've seemed to develop was they never created an economy of consumers, which usually is what gets the feedback loop with a positive outcome going in growing economies. What they did is they started reinvesting in savings, and those savings showed up in real estate. And it's a really unfortunate situation that they have over there, is because the real estate companies are starting to default. You saw Country Garden last week. Evergrande, which has been teetering forever, filed for Chapter 15 protection in the United States last week. And these are construction companies that, just reading what I read in the press like everyone else, have hundreds of billions of dollars of liabilities, and they don't have any cash. Their assets, and I put assets in air quotes, are these somewhat constructed houses and condominium projects where the vast majority of Chinese producers have parked their savings as down payments. And so you have this really big problem where, you put your down payment to buy a condo. The condo is not going to be finished. You're on the hook to the bank to pay the mortgage, and the company that's supposed to finish the condo is going to go out of business. And so either the bank, you, or the condo is going to lose, probably all three of you. And it's going to be hard for them to get out of this pickle, because they need to create an economy where consumers consume. And it's going to be hard to transition to that after peak population, which was estimated to have been reached in 2020.
Interesting what you say about the consumers don't spend on the same level as in the the US consumers, where we're told 70% of the economy is made up of consumption. But I think some of that might well be because they don't have the same social safety net as we have in the US, but could be other reasons, obviously. But something like 25% of GDP in China is tied to real estate. That's a pretty huge number. But over the weekend, I heard a commentator note that China has $2 trillion in reserves it could tap if there was some kind of a massive fiasco. I'm wondering, will we see the government step up with maybe more stimulus?
Well, some of those reserves are disputed because some of them are from the Belt and Road Project, where they dumped their reserves into an airport in Pakistan or a port in Sri Lanka or whatever, and doesn't have the economic value of the money they put into it. But they have the same problem the Fed has, which is they're carrying that on their balance sheet as a foreign reserve when it's probably not liquid and probably not able to be tapped.
No. I think you're right. I think that, you have to look at the other side of the balance sheet, and you see that the liabilities are eating up those reserves, and that the reserves may not have the asset values similar to what we're saying about American banks that have been stated. So I think what Matt says is exactly correct.
Dick and Matt, a great conversation. We'll be back next week, and post Jackson Hole. That should be an interesting conversation. And until then, episode 84. Take care.
Current and future holdings are subject to risk, and past performance is no guarantee of future results. This podcast should not be copied, distributed, published, or reproduced in whole or in part. Information presented herein is for discussion and illustrative purposes only, and is not a recommendation or an offer or solicitation to buy or sell any securities. Securities identified do not represent all of the securities purchased, sold, or recommended to clients. The views and opinions expressed by the ODEON Capital Group speaker are their own as of the date of the recording. Any such views are subject to change at any time based upon market or other conditions, and ODEON Capital Group disclaims any responsibility to update such views. These views should not be relied on as investment advice, and because investment decisions are based on numerous factors, may not be relied on as an indication of trading intent on behalf of any ODEON Capital Group product. Neither ODEON Capital Group nor the speakers can be held responsible for any direct or incidental loss incurred by applying any of the information offered.